Good morning. You are watching a live daily market outlook for Wednesday, 2nd of May 2012, prepared by Windsor Brokers. Dollar's short-term recovery triggered by upbeat U.S. data is continuing as the greenback is taking a break after a longer down move that brought the U.S. dollar index from its recent highs above 80 down to 78.60. That was the low of yesterday. From the other side, the single currency and sterling have eased yesterday after a release of U.S. Manufacturing data, with the single currency currently testing, hovering around 132 as strong support, and the cable holding around the 162 zone. That also acts as a strong support. The significant was a bounce of dollar against Japanese yen that was in the sharp down move and initially lost the 80 support, dipping down to 79.63 ahead of yesterday's strong rally that is now seeing some potential of further recovery. However, we need to see some break of some important levels in order to confirm, and more of this is going to be heard on our technical part. Also, the dollar against Swiss franc is emerging out of dangerous zone after a brief break yesterday below 90.50 support. Currently is moving around the 91 level as initial resistance. As immediate reaction of a stronger dollar, the gold fell off recent peaks at 1670 down to 1650 zone, currently moving around 1655, while crude oil remains well supported, and the overnight yesterday's strong rally of 104.50 zone has resulted in the hitting a fresh high at 106.41 so far. This was the peak of yesterday, with the overnight's action seen in the corrective mode down towards 105.50 level. The crude oil was supported by positive manufacturing data from United States and China that basically lift hopes of higher oil demand at the world's top two energy consumers. Just a reminder that U.S. manufacturing growth in April hit its highest level in 10 months, while China's factory sector also expanded last month, as the government data showed on yesterday's release. Also, the private sector survey geared towards smaller Chinese firms also showed that manufacturing activities improved in April, but still remaining below the threshold of 50 that divides expansion from contraction. And more from US is to be seen today on the indicator ahead of our key release of Friday, the US non-farm payrolls. Today's ADP jobs data that will give us an indication of possible result of the non-farm payrolls. Just a reminder that NFP is forecasted at 170,000 compared to disappointing last month's 120,000. We're going to take a look now in today's calendar and see what are the events set to be released. As overnight's release of Japanese average cash earnings for April showed the increase to 1.3% compared to 0.4% consensus, as well as China's manufacturing PMI, as mentioned already, 49.3 was released, slightly better than the previous one at 49.01. This is the what we mentioned recently, that is still holding below 50, but improvements are pointing that further recovery would be likely. Swiss retail sales are just released now for a month of March. We still don't have the figures. I will update you later on. With the Swiss PMI due at 7:30 GMT, with improvement to 51.6 compared to 51.1 seen today, expected for today. Still to come, 7:55 is a German unemployment change that is expected to decrease to by minus 9,000 compared to the previous release of minus 18,000. Eurozone, the final manufacturing PMI is due at 8 o'clock GMT, and no changes seen for today, as forecast is 46 compared to previous month release, March, at the same level. UK's construction PMI is due at 8.30, and decrease from previous month of 56.7 is forecasted today, with the consensus at 54.2. Net lending to individuals for month of March is expected to increase to 1.7 billion pounds compared to 1.6 billion pounds of February's release, and mortgage approvals are expected slightly to decrease to 48,000 compared to 49,000 of the February. For money supply for UK forecasted at 0.4% compared to minus 1.9% of February's release. Eurozone's unemployment rate is due at 9 o'clock GMT, and it's expected to go higher to 10.9% compared to February's unemployment at 10.8%. As mentioned, the US ADP non-farm employment change for April is due at 12:15 GMT, and this is the first and main indicator for the coming non-farm payrolls that are due on Friday. 179,000 new jobs are forecasted for today, below the previous month of 209,000. We're going to closely watch this indicator today, as this is the best indicator for the coming non-farm payrolls. U.S. factory orders for March are due at 1400 GMT, with the negative consensus forecast for today at minus 1.4% compared to plus 1.3% increase in orders of the month of February. And finally, U.S. weekly crude oil inventories are due at 14:30 GMT, and therefore a straight sixth week increase in the crude stocks. Today's build is expected at by 2.3 million barrels compared to 4 million barrels build of the previous week release. That was all from today's calendar. Now we are going to take a look at the markets and see the latest movements of majors and commodities. As said at the beginning, the euro is in near-term defensive mode after yesterday's rally peaked at 132.82, just ahead of our next barrier at 132.85, the main bear trend line, as well as 133.00 as around the figure resistance. Currently the pair is being so far supported by 132 zone that was hit several times from yesterday, but still holding the downside. That this might keep the overall positive tone and structure of 129.93 low of 16th of April in play, as 55 days exponential moving average so far is containing. We need to see the break immediately above this level 132.29 is 20 days exponential moving average that is currently limiting upside, and a more significant range, yesterday's range top at 132.43, with the firm break here required to refocus upside levels for possible extension up towards 132.82 and possible test of 133.00. On the downside, the risk seen on loss of 132 support that would open next significant levels 131.72, 38.2% Fibonacci retracement of 129.93 to 132.82 rally, as well as a previous high of 20th of April at the same level. One previous high of 17th of April at 131.71, and last Friday's low at 131.57. That will be the next levels to watch in case of a break below 132.00. Studies on the 4-hour chart are in rather neutral mode at this point, while negative structure remains in the hourly studies after yesterday's sharp fall of 132.82, and that weakened the near-term structure. As said, we need to see the break above minimum 132.40.50 in order to improve the near-term picture and refocus upside levels. Otherwise, risk remains. Near-term risk remains at the downside with the break of 132 to open 131.72 and the 131.57 low of last Friday. On the daily picture, the outlook is still in a way positive, but the gains are still capped by the trend line resistance, and we need to see the break above 133.00 to confirm the positive structure of 130 base rally, and to refocus next significant barrier at 133.80 zone peaks of end of March and beginning of February. British pound, the near-term price action is seen in the sideways mode, moving within the 161.85 and the 162.46 range, following the pullback of 2 days ago, fresh high of 6 months at 163.00. This was our initial target that was briefly touched, but failed. The pair failed to break higher, with subsequent easing. So far seen corrective as approximately 50% of the latest upleg from 160.80 to 163.00 is so far holding the downside. Slight improvement is seen on the hourly studies that keep hopes of further recovery higher, with the break above recent range top at 162.46 required to confirm a basing attempt at 162.00, 161.85 and refocus upside levels. On the larger time frames, 4-hour studies are still in the positive territory, but so far still pointing lower, and this keeps sees existing risk of further easing. So far, 20 days exponential moving average currently at 162.19 holds the downside, with the loss of this level and more significant 162.00 and 161.85 to open next dynamic support at 161.54, 55 days exponential moving average, along with the low of 27th of April at 161.52. More significant would be loss of 161 zone that will open directly our key barrier and break point at 160.80, 160.61 previous high of 2nd of April, and lows of 23rd and 25th of April, loss of which would more significantly weaken the short-term structure and refocus downside levels at 160.00 and lower. On the upside, the immediate focus is still on the 163 as long as 162.00 holds, and the break above this level to open next Fibonacci barrier at 163.88. That marks 76.4% retracement of the broader down move from 167.45 to 152.33, a peak of 2011 and a low of 2012, ahead of 164.00 as a round figure barrier. As mentioned in the introduction, the dollar yen is in near-term recovery mode after hitting fresh low yesterday at 79.63 levels, last time seen end of October 2011, after the pair bounced on the Bank of Japan's intervention from 75.56, peaked at 79.52. The low hit yesterday is just a few ticks above our initial target at 79.52, with the subsequent bounce on the strong US data that supported the dollar, regaining initial barriers at 80.00 and 80.28, with the 80.60 seen so far. This is approximately our next target lows of 26th of April 2012. Further gains and the break above 80.65, which is also 55 days exponential moving average, along with the 81 20 approximately, where is the main bear trend line drawn of 84.08 peak, and connecting 83.29 and 81.68 peaks is required to confirm the base at 79.63, as 90 days moving average so far contains the downside. Set the break above 81.20 is required to avert immediate downside risk, and break above next very significant barrier, lower top of 20th of April at 81.77 required to confirm, and the signal possible end of a short-term corrective pullback of 84.17 yearly high posted on the 15th of March. On the downside, failure to break 81.20 would signal an extension of the short-term downtrend of 84.17 with the loss of 79.63 and 79.52 to open the next significant points on the downside. 79.13 is the 61.8% retracement of 76 to 84.17 rally, and 79.00 as the around figure support. And negative structure on the daily chart still keeps the downside favored, as long as trend line barrier at 81.20 holds upside. Otherwise, break here to ease the current bear pressure and open next significant barrier at 81.77. The dollar Swiss on its near-term recovery, trading off yesterday's fresh low at 90.41 when the pair briefly broke below near-term base at 90.50, is so far flirting with the 91 zone, where is also descending a trend line drawn of 92.08 peak, as well as 55 days exponential moving average. We need to see the break of this initial barrier in order to signal a stronger correction of the latest bear trend of 92.50 high of 16th of April, and to avert immediate downside risk with the next level at 91.31 high of 27th of April seen on a break. Failure to clearly break 91.00 still sees a risk of a further extension of the broader downtrend, as the studies on the 4-hour chart are still in the negative territory. Some turn higher and the pointing higher is seen, but as long as 91.30 holds the downside, there is quite a big risk of further extension lower. On 1-hour chart, there is improvement in the studies, but it seems that the pair is running out of steam at these points, as several attempts at 91 so far failed. Daily structure still keeps downside risk, as studies are slightly below their midlines, with yesterday's brief test of the triangle support at 90.50 being so far short-lived, as the pair broke briefly lower to 90.41. However, risk remains on the downside, as 91.20, also 55 days moving average holds the upside attempts, and the main bear trend line of yearly top at 95.93, currently standing at 91.42. So break above 91.30 and 91.40 zone is required to improve the larger picture of dollar Swiss, as the pair currently moves within the triangle and narrowing its range. However, the focus is still more to the downside, as long as trend line holds the upside action. As said at the beginning, the gold was affected by the recent positive data that supported the US dollar, and the subsequent easing seen on the yellow metal of yesterday's high at 1671, that bottomed so far at 1654. That was a low of this morning. A negative tone is seen on the hourly chart, as studies broke below their midline, and the pair breaks below the key moving averages on the short term 20 and 55 days, with the 20 days one crossing the 55 days one, keeping the immediate focus at the downside. 4-hour structure is now the studies are weakening. Loss of momentum sees potential for attack, which has already been tested at 1654, the 55 days moving average, loss of which would result of in further easing, with the next support at 1644, low of 30th of April, ahead of more significant double bottom at 1624. Daily structure keeps the pair still at the dangerous zone, important actually, barrier, the trend line resistance that was briefly broken yesterday, but still we need to see the clear lift above this level, and as long as 20 days moving average on daily chart currently at 1650 holds, there is potential of further extension higher, despite the pair is now losing the gold is losing momentum, and the stochastic is started to point lower. That actually increases risk failure to break this trend line barrier, and regain of more significant barriers at 1676 and 1679 would see risk of further easing, as the gold remains in the downtrend of 1790 high of 29th of February. Immediate downside support is at 1636, the trend line support, ahead of 1623 double bottom, and more significant 1612 low of 4th of April 2012. And finally, a quick look at the crude oil that bounced higher after yesterday's after data released from US and China, increasing hopes of further and stronger demand for the crude oil. Break above a recent range top at 105.50 has so far seen 106.41 level, and approaching 106.76, 61.8% retracement of the latest 110.53 to 100.67 descent. As I mentioned yesterday, we were looking for test of 105.50 and 105.60 previous high, and 50% retracement in order to confirm the positive structure of 167 and 101.82 higher low that actually materialized yesterday. And now we'll be looking for a further extension higher, as there is improvement seen on the studies on the daily chart, as MACD is now breaking above the midline with the clearance of the next obstacle at 106.76 Fibonacci barrier required to refocus next significant levels at 108.22 and 108.68 peak of 19th of March 2012. Immediate support is now acting as now previous resistance at 105.50 and also 104.30 is the 55 days moving average as dynamic support, and holding above these levels, basically holding above 105 would keep the near-term strong structure in play for a possible test of previously mentioned levels at 108.22 and 108.68. That was all for today. We're back tomorrow morning at the same time, 7:00 GMT. I wish you a very nice day. Thank you.